Okay. Good afternoon, everybody. Today is Friday, January 26th. This will be your weekly take on the market. Uh, I will be your host. My name is Scott St. Clair. I am the manager of the Premium Product Group here at Investors Business Daily. Uh, if you've watched this video before, you'll know that this screen or this bio is a little bit different. It's got a little bit more information about me. I do read and almost always respond. If I don't respond, it could be that it just slipped past the cracks, but I do get all your feedback. You guys send to us an email. And one guy, his feedback was, or his email was, who is this guy? Why should I listen to him? And thought that was very fair. I mean, if you just stumbled upon this video like he did on YouTube, I think, um, that was his, at least one of the feedback um, responses that he gave me. And so, if I get lots of positive feedback, I really appreciate it. And I get negative feedback like anybody. And I don't take myself so seriously that I can't listen to what somebody might have to say as long as it's constructive, and that's fine. So thought I would change my bio to give you a little bit of more about, like, okay, well, why am I doing this? And what kind of experience do I have in the markets? So I have 25 plus years market experience. Does that make me an expert? I guess it depends on your interpretation of the word expert. So, like, to me, somebody who has mastered the game of chess is an expert. Uh, yeah, I think the market is so dynamic and ever changing, um, that I don't know if I love that word expert, but people do use that word. But I have a lot of experience and a lot of market knowledge. I've read hundreds and hundreds of market related books, and just have immersed myself in, my whole adult life has been total immersion in the markets. I just love the game. So, um, that there's that. Started out as a stockbroker in 1995, opened my own personal account around the same time because I wanted to start trading, get some money in the market, even though I couldn't rub two nickels together when I first started. In '07, the firm I was at went under, a byproduct of the financial crisis early on, in fact. So I decided to kind of go off on my own. I just really wanted to trade markets. That's really what I loved and what I did best, and how I was making my living was, from the markets. I was a managing partner with a friend of mine, and for a while, we had our own capital company. In 2010, I decided I wanted to join the William O'Neill company. I just thought, I just want to go work for Bill. I thought, a la the model that a lot of the portfolio managers had done, from the books that I'd read, and I started, I got a job in the Marcus Smith team, which was good because this was a product that I was using. So that was in 2010. In 2015, I got some money at the William O'Neill on the portfolio management side, and how they do it there is everybody has a you keep your job and you manage the money in confluence with your job. There might be like one or two portfolio managers that I can think of that are, strictly portfolio managers, but even the CEO and the executives uh, run money and have outside responsibilities as far as the company. It's kind of the model that they use. And so that was a tremendous learning experience. I don't know what I can say from a disclosure standpoint about that, but I think it's okay for me to say that I really enjoyed my experience on that team, and it's very, very competitive uh, to be a portfolio manager at William O'Neill. You're not only competing against the market, which is tough enough, but you're competing against their legacy and their track record. and you're competing against your colleagues, because it's very much run like a, you know, a, a baseball team or a basketball team would be a better analogy. When I was in college in basketball, our coach used to always say, I'll never forget, he'd say that the best player got the most shots, and the second best player got the second most shots, and the third best player got the third most shots. And that makes sense, right? And that's kind of how they would do it, in general. So that was a great experience. With the move to Dow Jones, when Dow Jones bought Investors Business Daily, um, I became the manager of the premium product group here at Investors Business Daily. Arusha Pierce, a good friend of mine, is he stayed at William O'Neill. And on the academic side, MBA from University of California, Irvine, UCI. So that's me in a nutshell, 25 plus years market experience. As far as investing, I don't know. I guess what I will say is this system that Bill discovered, it works. The products and tools that we have to find great leading stocks, it works. I make as many, if not more, mistakes than anybody in the market. I promise you. You would think with experience you would stop making mistakes, but that's just not, at least for me, maybe for others, but at least for me, it's not the case. Still make a lot of mistakes, but I will say that since 2010, my my Roth IRA, because it's easier to monitor because I'm not making any withdrawals. I don't have to pay any taxes on it. Is up 22-fold since September 2010. And the S&P has been in a great bull market for most of that time. There's been some tough periods, but one thing about our system is it protects you from those downswings. So you're always kind of within shouting distance of new highs. So I know the S&P hasn't gone up 22-fold. So I track that very, very closely. I monitor my equity curve, and so I can tell you exactly how well or how poorly I've done. Do I beat the market every year? No, but you don't have to, because there's been some years where the market has gotten me. Last year, for example, I did not do as well as the NASDAQ, for sure. NASDAQ beat the pants off of me. But in the COVID year, COVID bull market, I did tremendous. And in the bear market that followed, I did really well. I didn't. I had a positive return while the market went down. So there's that. So I guess to his question, who is this guy? Why should I listen to him? There's that. The next time I do this video, it will be much shorter when I talk about my bio. I don't know. I'm a little reluctant to talk about myself. Because it's a tough game. It's not easy being a market operator, but it sure is exciting. It sure is intellectually stimulating, and so I definitely bring that to the table. All right, so here's the disclaimer. Nothing I say. I'm not licensed any longer. Haven't had a license for years and years and years. So this is for educational purposes, informational purposes only. Please take a moment to read the disclaimer. The other thing about the feedback is it said it felt like I was unprepared. And so that I don't want to say I disagree with it, but let me give you an idea on how these videos work. I don't prepare. They're not polished YouTube presentations. I don't know if maybe he stumbled upon it on YouTube. So I don't practice or write down. There's no script. It's off the cuff a little bit, and that's the way I prefer it. So you just kind of get my thought process. I do give myself notes with slides, and I do create some notes on things I wanted to talk about. And so I do that, but I prefer the kind of podcast-ish flow of how these videos go. And so there's that. And if you like it, great. And if you don't, well, it didn't cost you a penny, so you can just turn it off and go on to the next video. Okay, so market thoughts, industry groups, stocks to watch, quote of the week. The routine is almost always the same. Last but not least, one more housekeeping item. We do have a rebrand. We are in the process of adding some new features to MarketSmith, changing the name. A lot of you probably already know that with the email that we sent. And so more of that to follow for sure. Tomorrow, there's an event, MarketSmith Academy. It's a learning event, free to attend as a subscriber. And I'll talk a little bit more about that at that point. But yesterday is just the first of many correspondences from us to you to kind of guide you with that process. Okay, so let's jump into the markets. A friend of mine sent me this from Capital Group. I thought it was very interesting. So there's what, 2, 4, 6, 8, 9 stocks. I don't know if the Nifty 50 was truly 50 stocks. I know there was more than 9. I don't see Polaroid on here. I remember Polaroid being one of them. But it looks like it topped out as a percentage of the S&P 50, I'm sorry, S&P 500 at about 40%. So here you are with the Mag 7 at around 27%. So if you are bearish the Mag 7 and your analog is the Nifty 50, well, you got a lot more room for to be wrong in as far as the percentage of S&P, if that's your metric. And then, I think today Kramer mentioned that Tesla no longer, belongs in the Mag 7. I don't know what he would replace it with or something. I think I saw that on Twitter, but so it's Tesla, and we'll pull that up later, has not performed very well at all. It's actually performed very, very poorly. So the Mag 7 is really the super Mag 5. Even Apple's a bit pedestrian lately. So, but so there's room for it to continue. Let's see. AAII sentiment survey actually decreased in bullishness, which is very interesting considering the market's gone up. Almost always it's tit for tat along the way. And Jason Shapiro, who was in Hedge Fund Market Wizards, he tweeted about this, and he said he felt like it almost tongue in cheek, like, well, we're not going to fall for the banana in the tailpipe, so to speak, and get bullish while the market goes up. We've seen how that plays out, and so there's an adage that the market climbs a wall of worry, and this market definitely has a little bit. We'll pull it up now. So here's the NASDAQ. The market's not closed, but just a little bit of downside action today. And it's been very, very, very good rally. I would say, the only fly in the ointment for me is like it's so good that I'm worried about, there's going to be something along the way to kind of trip up the market or scare the market. It's always nice to already know it because then once it's known, it's mostly, if not already priced into the market. So like here's this is the banking crisis down in this area in March of last year. First Republic, Signature Bank, Silicon Valley. I don't remember if there was another one, but they all went belly up. And everyone talking about, oh, here comes banking crisis 2.0. And guess what? Led to a big rally. So the market found out the news and it voted by saying, this isn't an issue. Now, you could say, well, the government came in and created some program and blah, blah, blah. Okay, yeah, maybe that's what happened. So it could have been an issue. And maybe in this area, you're nervous about it and you're not fully invested, you're on the sidelines or whatever it might be. But when the facts change, you need to change. So as soon as the market stops going down and starts going up, regardless of what you think, the market says, like Bill would say, well, I'm now in an uptrend and I don't care how you feel or what you think. And that's the best way, I think. There's no perfect answer in the market. The market's dynamic, ever changing. You have to be willing to change with it, be flexible and open to what's going on. That's why you just look at it day by day by day. There's no reason to be bearish the market at this very moment. You want to be bearish Tesla or something like that? Okay. You want to be bearish? Oh, what else out there is not acting well? I'm trying to think of something that I might consider shorting if the market changed. And there's very little of that. But right here, what's if the picture you have right here is a market that's acting just fine. S&P, same. Not a whole lot there. The Russell, okay, so let's talk about the Russell a little bit. Very difficult index. Never really goes anywhere. So the Russell hasn't made a new high since 2021, November 2021. So we're a year, I'm sorry, 2.5 years on that high. So, then, and that's because of where the focus is, where the money's going. The money's going to the big cap tech. So it's either mostly, not always. There are some other names that are acting really well. I'll pull them up. But that's where the money's going. So that's where you want to be, not totally focused, but you want to have exposure there because that's where the institutions are exposed. So the Russell, it's just meh. It's not terrible. It's okay. It's not as good as the others, of course. There are some international indexes that are acting okay. EWJ is one, Japan, although it's losing a little bit of relative strength here. But and then China, which is, you've gotten this big bounce off the bottom, but it's, what are we? 52-week high is 32%, and its high back here at 54 is, more than in half. So not really, obviously, a great place to be invested. So that's the indexes. I don't know if there's a whole lot to say about them. I think IBD has us at like 60 to 80% exposure. There's some distribution days on the market, mostly with stalling. So, like here where the market tried to go up, but then closed on the lows and the volume was higher than previously. This looks like a very, very minor stall day right there too. I don't know if that was counted on that, the big picture, but read the big picture if you're interested in kind of the thought process for the IBD editorial staff and on how they determine their exposure numbers. Okay, let's go to the I'm sorry, the industry groups. Energy coal is one. AMR is the 800-pound gorilla in that group. Computer software security, such a good group. Palo Alto, Sentinel-1 is kind of a smaller name, but CrowdStrike is one that I love. Zscaler, so it's a very good group. If AI is even half real, I would think computer software security is going to be a factor. Biotech. Very interesting that biotech with a huge number of stocks is holding up really well, but I think Amgen, Vertex, a couple of names that are doing well. Computer software, financial, medical, long-term care. So you see, it's very diverse. And just the first 5-6 names of coal, security, biotech, long-term care, computer software, computer hardware. That would be like SMCI and Dell. Apparel, shoes. So there's a lot to choose from. I think the industry groups are fine. They're very diverse and and leaders. You could own, NVIDIA, you could own SMCI, you could own Lululemon, you could own AMR, you could own United Rentals, URI, you could own CCJ, uranium play, NVO, a drug play. And you could go on Kramer's show, Am I Diversified? And I think you would win. You would win you'd qualify. So it's very, very good group action so far. So let's jump to stocks, and I have a lot of them. So and I'm just going to go by how I wrote them down. Melli, I don't own Melli. I don't know why I don't own Melli, because I like Argentina. That's another international market, seems to be turning the corner. And but this is a great company. Look at the quarterly earnings and sales, just so good. Look at those margins, gross margins of 50%. Even I talked earlier about mistakes I've made. Here's a mistake of omission, I guess. This is a stock I should own and don't. I do own this one, GGAL, not as good as Melli, but up 1, 2, 3, 4, 5, 6, 7 days in a row. Every day I keep thinking it's going to pull back, and it hasn't so far. The weekly chart, very strong, coming out of this big base here. And I don't remember which time period I owned it before. It might have been here. It might have been here. It was one of these time periods. I don't think it was this one. I think it was one of those where, the stock went up, tenfold. So $1 split adjusted to 10, $1.80 to 16, 5 and change to 70. And if this is one of those time periods, you're looking at, let's say, 6 to 60, a tenfold move. Am I going to be there for a tenfold move? I could say with a lot of likelihood, no, but I might be able to capture a portion of that move in bunches, in a couple of times. This is a monthly chart, so maybe I catch that part, and then I catch that part, and then I catch that part, something like that. That's been my experience with multi-bagger stocks. Is I don't hold them for the whole move, but I'm able to capture a large portion here and there of the move. And with the size that we use and I use, I'm not going to have 0.5% position. I'm going to have a 10, 12, 15, 17% position, something like that. And it'll make a difference to my portfolio. So that's right from the tools that we have, which make us different. Stock selection. Speaking of my days at on the O'Neill side, Steve Birch, the CEO of O'Neill, I believe he's CEO, used to say, what do we do differently? Stock selection, right? Or leadership. We're NVIDIAs of the world. We have the tools to identify these stocks, earnings, sales, return on equity, et cetera, industry group ranking, fund ownership. Do any of that? Is Fidelity Contra buying this stock? Is Bailey Gifford buying this stock? Things like that. So stock selection would always be one. Concentration. So we don't have a 1% position of a great winning stock. You're going to find a way to buy it, and you're going to find a way to add to it if it works. Some market timing. So we have a system to sidestep really bad markets. It's not perfect. It'll give you some false positives for sure, but it's going to identify when you should be, if not completely out, almost completely out. And it's like it's like in poker, every dollar not lost is a dollar won. And so when the market goes down 60%, you go down 6%, or the market goes down 30% and you go down 6%. That gives you a big much better lead way for the next cycle, because you haven't dug such a big hole to have to come out of. So this is very interesting to me. MELI, GGAL, Globant, which is an international stock. I think it needs to take out this this little pivot that I've drawn here. This looks like a little flat base to me. On the weekly, we've got a flat base pivot. I do own a starter position in this. So how will I do this? I will buy, let's just say I want 300 shares. I'll already own the 100. If I'm wrong, I'll take a small loss. If it goes through this, I'll buy another 100. And if it goes through that, I'll buy my last 100, something like that. SMCI. Oops, SMCI. Just acting like a beast. Here's the weekly chart. And it gapped up on earnings here. There. And such a powerful move. Up 35% in one day. You can see I went back and looked at like Qualcomm, and how did Qualcomm, when it broke out of now this isn't, this is not the first stage for this stock, right? This stock has already made a big move. So keep that in mind. But I was like, well, what did Qualcomm do when it broke out of a base after having already made a really big move? And based on my, I'm trying to piece like an analog my precedents together. I think that I've got a target of 559 for this stock. What does that mean? It almost means nothing, but I put that there as to help me to stay in the stock, because it's really volatile. This stock is really volatile. I mean, this was 480 down to 410 in one session. That's going to be pretty tough to stomach if, with a full position. So if I'm going to somehow stay for another 100 points or whatever it might be, I've got to, size accordingly. So, and that's the magic, really, is having enough of the stock that it matters if you get it right, but not too much that you get shaken out. If it goes to 600, in hindsight, I'll be like, well, gosh, just if I just kept, the couple thousand shares here, I'd be a genius. Well, it's not realistic, to have 2,000 shares and watch it go from 480 to 410 in less than a session. I'm going to get knocked out of the box. I'm going to panic sell at some point when that happens. And so that's why you have to have the right position size, that if it works, it makes a big difference, but not too much that I don't get shaken out. So this is definitely leading stock. I'm really, they pre-announced the earnings are next week. I'm going to be curious to see what that looks like down below here in this box. AMD, very, very extended, really leading stock, earnings next week. And this might be a theme, right? Because you're going to start to see that. NVIDIA. So you've triggered the 8-week hold rule. Okay. Somebody emailed me about that. What does that mean? Do I have to hold it for 8 weeks? Well, like I said, I'm not licensed. I can't tell you what to do. But what does this mean? It's just a sign of power, of strength. So if you want to use that rule, it's triggered. You have to decide for yourself. Do I want to use that rule? I would say that if you're going to, you obviously don't want to get stopped out. So I would use 500, 505, 510 as your ultimate line in the sand if you're going to do that. But basically you're looking at 3 weeks. Now you've got like this 5-week window. And the reason Bill came up with that rule is because it always seemed to be somewhere in that 5-week window, there was a shakeout. And the rule is designed to help you survive that potential shakeout. I use this rule very sparingly. It really depends on the stock, but that's kind of how I would use that rule. It's got to be really special. I've done it before. It's not easy. The shakeouts they always seem to come, and even though you know they're coming, it's still very difficult. TSM broke out, acting great. Semis are just on fire. It's just such a good group. Semi. Look at Lam Research, although it's a little bit of profit taking in this 20% zone from here, but another good one. CrowdStrike in the security hit that round number of 300. It's pulled back a little bit. I'm hopeful that you get something like that. That'll give me a chance to reposition accordingly. The NVO earnings in 5 days, not that dynamic, big company, but acting like leadership. And, when I talk about like, the tools that we use, I mentioned like stock selection and fund ownership. So if you open up the panel in MarketSmith here, you can see that Allspring Growth created a new position in the December quarter of last year. Excuse me. MFS has reduced their position slightly from 1.07 million, 0.58, 0.57. And if you want to really dig in, you can click on Show Fund Ownership. And then down below in this list panel, we'll give you all the mutual funds in our database. Not every mutual fund out there, but all of the mutual funds in our database that have a position in that stock. So it's a good way to do do that sponsorship work. Sponsorship's a big deal. One of the most common questions Bill would ask his portfolio managers, and I never worked with Bill, but he was basically retired by the time I was there. But one of the common questions he would ask guys like Mike Webster, for example, is, who are the sponsors? So if Mike came to him and said, I really like Novo, Bill would say, well, who are the sponsors? Who has a position in this stock already? CCJ, a little tougher, got a little bit, I think it felt like there was just a lot of positive energy about uranium at that point. And so it's done what it always does, shakes, this is the shakeout that I'm, always fearful of, but it's acting okay if you still have that one. Palo Alto, same group as CrowdStrike, very good. And you can see a theme. There's a lot of names they're extended. They're not doing anything wrong. If you bought them correctly, you can just sit with them. If you feel like, I would say at this point in the rally, you probably want to batten down the hatches a little bit. Like if you had 15, 20 stocks, you'd probably want to call your portfolio down to 7 to 9, maybe get rid of some of the lesser quality names, the ones you have less conviction in. It's probably something that I would consider this weekend for work for you to do. URI, United Rental. Look at that breakout. Acting great. Netflix. So gaps up. Another thing to watch when they gap up. Do they hold the gap? So far, yes. The gap was around 550 or so, and stock's 570. Another good sign for market strength. Are they holding? When they go up, do they stay up? right? That's a thing I would often say. Sometimes I find myself in situations I'll be like buying stocks and I'll be frustrated because I can find stocks to go up. I just can't find them to stay up. So that's food for thought. AMR on the coal side, very, very extended, but wow, what a beast. The reason I wanted to bring this one up is because somebody mentioned like the stage count. So it is a fifth stage base that it broke out of. So it is a later stage base. Keep that in mind if you were, when you're considering stocks. There is, I can't think of any one thing where I would say I would not buy that stock if this. I know the EPS rating is very low, it's 10. So I would never say, oh, I'd not buy that stock if the EPS was less than 50. It's a it's a puzzle. I'd prefer for all of the items that I look for to fit perfectly, but you're just not going to have that. If you're looking for a perfect stock, you're going to have a hard time buying stocks. You're not going to find hardly anything, and so you'll be frustrated. When Nvidia broke out of the cup, geez, you can't even see it now. When Nvidia broke out there, the earnings on the stock chart were awful. Okay, so if you said, "Oh, I only buy stocks with earnings up 25% or more," then you can't buy Nvidia there. You've got to wait till here, and then it got really tough. A couple of shakeouts. So what the market is doing is looking forward in anticipation of these big earnings, or when they sell off, like here, Nvidia breaks out there, and the earnings on the chart are really, really good. And what happened is, for whatever reason, their business slowed down, the economy slowed down, whatever. A million things can happen. And somehow the market knows, and it anticipated this slowdown in the earnings right here. Right? Got in front of that, but then started to go up in anticipation of this. Right. And so that's why it's important to read the tea leaves on how the stocks are acting. I promised the person that emailed us I would address the AMR, the fifth stage base. I'll tell you, I know this might go against the system a little bit, but I'll tell you, I find that later stage bases seem to work really, really well. And I've thought about it, like, why? Why would a later stage base work so well? And the thing I can think of that is that the quality of the company, or the the tailwinds of the industry group, in this case it's coal, are so strong that it never goes down and undercuts a previous base to reset the count. So I've had some really good late stage bases. I mean, I remember ABMD, which was broke out of a 7-stage base and went up really, really good. I remember a Chinese um, education stock, XRS. At the time, it was TAL. I think it was like almost like a 10th stage base. It was like an incredible number, really high, and stock went up really well. So the quality of the company, something's going on that allows that stock to build a later stage base. And if I'm wrong, I bought AMR here, and still don't own. I don't want to give that impression that I do. I got wiggled out lower than where it is now, but if I'm wrong and it goes down, I don't care if it's first stage base or a 50th stage base, I'm going to stop myself out. So that's why I have no problem buying later stage bases. CRM and a few more here. Nothing. It's just acting just fine. Lululemon. You got to pull back to the moving average here, holding so far. So if you have that one and you're using the moving average, so far so good. American Express, name from the past. Look at that. So it's just getting lots of that. signs that the market is healthy and fine. It's very few signs so far, anyways. I'm always looking for them, but very few signs so far that of the market changing. IBM, when IBM gaps up 9%, this is at 1970. That's an amazing strong move for a stock like IBM. So things like that. The one stock which I have been short and was portending the weakness was Tesla. So it was not easy to stay short like this. Like every day you'd come in, the market's strong, and you're short this stock. It's like, what's the point, Scott? I used to think about that. And it just never did anything to knock me out of the box. And look at the relative strength. Look how poor it was acting before the report. Strength begets strength. Weakness begets weakness. When you have weakness, it's like if Tesla can't go up in this market, when is it going to go up, right? And so what happened is they reported earnings, and this again, the street kind of knew it was a really, really poor report. Their margins were bad, sales were bad, earnings are bad. It just was not a good report, and stock acted accordingly, down 12% that day. I am no longer short the stock. I just think that the market is so good. I'd rather concentrate a little bit more about in that area. And my experience, and right from Bill's short selling book, is when you get a windfall on the short side, you should take it. You don't want to turn this chart upside down. Like if you look here, it gaps down. It did go a little bit lower, but if you had covered that day around 215, you're really glad you did up here. How about this move down? 212 to 278. So I would expect some kind of rally. It might be from there to there. I don't know, but I had a windfall, had a good day in the stock, moved on for now, and it's on the watch list for now. Okay, I think that's it for stocks. Let's jump to the quote of the week. Bear with me here. From Cole Moshe, Hedge Fund Market Wizards. I really love the Market Wizards books. I can read those over and over and over. There was something going on. I didn't need to know why. Once you realize something is happening, you can trade accordingly, right? And you don't have to have all the answers to put a trade on. Invest first, investigate later. That's the George Soros quote. You see something compelling, something about XYZ is compelling to you, put a position on. You can always get out if you're wrong. It doesn't have to be a monster position, but it could be a probing starting position. And then you could start to get feedback from that stock. Hypothesis is something big is happening. I don't know what it is. So powerful, will carry on for a long time. I should participate in this. If I am wrong, I will have a limited loss. If I am right, who knows what could happen. I love this quote. I've got it sitting on my desk here as a reminder of why I buy some of these stocks. SMCI, Nvidia, AMD, and I didn't have an AMD. But boy, if I'm right, they could go a long way. And even though I might mess it up along the way somewhere, it's frustrating. But if they go a long way and I mess it up, I still can make a lot of money. That's been my experience in the market for years and years and years. Somewhere along the way, I kind of mess it up, but man, the returns have paid for it. It's somehow it's worked, by messing it up and still doing really well. You don't have to be perfect in the stock market. It's just not the place where you need to be perfect. All right. So I appreciate it. Here is our contact information, marcusmith@investors.com, 800-424-9033. This video, I don't know, it's probably pretty long. Apologize for that, but hopefully you got something out of it. We've got the Saturday event tomorrow. More information to come on the new features with the product and the rebrand. And next week you've got Harold and Arnie on the Stay in Step on Thursday. So I will be taking next Friday off. Have a great weekend, everybody. If you're coming tomorrow, great. I'll talk to you then. If not, we will see you in a few weeks. Bye, everyone.